Imagine waking up on January 1st, 2026, opening your banking app and realizing you are starting from absolute zero. No investments, no retirement accounts, no emergency fund, maybe a few lingering debts. A job that covers your bills but leaves little room to breathe. The headlines are loud, dramatic, and relentless. Interest rates are higher than they were a few years ago. Artificial intelligence is replacing entire job categories. Housing prices still feel out of reach. Commentators are arguing about whether we are heading into a slowdown or a boom. Most people freeze in this moment. They assume the system is rigged. They assume they missed their chance. They assume wealth was something you had to start building back in 2015 or earlier. So they hesitate, they wait, and while they wait, time quietly compounds against them. But if I had to start from zero in 2026, knowing what I know about economic cycles, compounding mathematics, and human behavior, I would not panic. In fact, I would see it as one of the cleanest starting points in over a decade, because starting from zero means you have no baggage, no emotional attachment to past investment mistakes, no sunk cost bias clouding your decisions. You are simply at the beginning of a new financial story, and beginnings are powerful. The first thing I would do is confront a truth that most people try to avoid. If you have high interest debt, you are not at zero. You are in negative territory, and negative compounding is one of the most destructive forces in personal finance. We talk endlessly about how powerful compounding returns can be when investing, but we rarely talk about how devastating compounding interest can be when it is working against us. A credit card charging 22 or 24% interest is not a minor inconvenience. It is a guaranteed drain on your future. Paying off a 24% interest rate is mathematically equivalent to earning a guaranteed 24% return. There is almost no legitimate investment that can offer that kind of return without extreme risk. So if I wake up in 2026 with $5,000 in high-interest debt, I am not browsing stock apps. I am not researching crypto tokens. I am not watching market predictions. I am becoming a debt eliminator. I would list every single liability from the highest interest rate to the lowest and attack the most expensive one first. This is known as the avalanche method. Minimum payments on everything else. Every extra dollar toward the highest rate balance. Sell unused items. Reduce unnecessary subscriptions. Temporarily downgrade lifestyle choices. Not forever, just long enough to remove the financial handcuffs. Because debt is not just about numbers, it is about psychology. When you owe money at high interest rates, you feel pressure. That pressure makes you risk-averse in your career. It makes you afraid to negotiate, afraid to switch jobs, afraid to move cities, afraid to experiment with new opportunities. The true cost of debt is not just the interest percentage, it is the reduced range of life decisions. Once high-interest debt is gone, something changes internally. You stand a little taller, you negotiate differently. You are no longer making decisions from scarcity, you are making them from strategy. After eliminating toxic debt, the next step is something many people skip because it feels boring. I would build a cash buffer. Not an investment account, not a trading account, a simple, boring, liquid emergency fund. 3 to 6 months of essential living expenses. Not lifestyle expenses, not travel budgets. Just rent or mortgage, utilities, food, transportation, insurance. The reason this is critical in 2026 is because volatility is normal. Markets fluctuate, jobs change, industries evolve. If all of your capital is tied up in investments, and an emergency strikes during a market downturn, you are forced to sell at the worst possible moment. That locks in losses and permanently damages your compounding potential. Cash is not meant to grow aggressively. It is meant to protect your investments from being disturbed. Think of it as a firewall between life's unpredictability and your long-term wealth engine. With 3 to 6 months saved, you gain emotional stability. And emotional stability is one of the most underrated financial advantages in existence. Once the foundation is secure, we move to offense. And here is where most people misunderstand wealth building. They obsess over cutting small expenses while ignoring the power of increasing income. There is a limit to how much you can reduce your spending. There is no clear ceiling to how much you can increase your earning potential. In 2026, technology continues reshaping industries. Some jobs disappear, others become highly valuable. If I am starting from zero, I am auditing my skills. I am asking one direct question. What skill, if mastered, would significantly increase my income within the next 2 years? It might be data analysis, it might be technical sales, It might be coding. It might be AI integration for businesses. It might be specialized healthcare certifications. The key is leverage. A skill that increases your base salary by $20,000 per year changes everything. It increases how much you can invest. It increases employer retirement contributions. It accelerates compounding. Instead of obsessing over how to save $5 on coffee, I would focus on how to add $5,000 to my annual income. That shift in mindset alone separates stagnation from momentum. Now, with debt cleared, a cash fortress built, and income expanding, investing begins. And here is where discipline must override excitement. The financial industry will always offer shiny distractions, new funds, trending sectors, speculative assets promising exponential returns. But history tells us something consistent. Over long periods, broad market index funds outperform the majority of active managers. That is not an opinion, it is data. Professionals with research teams and advanced models often fail to consistently beat the overall market. If they struggle, the probability of outperforming casually in your spare time is extremely low. So instead of trying to find the next winning stock, I would own the entire market. Low-cost, diversified index funds. Total market exposure. Domestic and international allocation based on risk tolerance. Automated monthly contributions. No market timing, no emotional trading. Investing should feel boring. If it feels thrilling, you are likely speculating rather than investing. But even within disciplined investing, psychology matters. Humans crave stimulation. We want action. We want to feel involved. One strategy that can balance discipline with curiosity is the core and satellite approach. 90% of investments in diversified index funds, 10% allocated to higher risk ideas if desired. That small allocation satisfies the urge to experiment without jeopardizing long-term stability. If the speculative portion performs well, it is a bonus. If it fails, your financial foundation remains intact. Taxes are another area where beginners lose enormous ground without realizing it. Where your money lives is as important as what it owns. In 2026, tax-advantaged accounts remain powerful tools. Employer retirement plans with matching contributions are essentially guaranteed returns. If an employer matches contributions up to a certain percentage, that is immediate doubling of that portion of your money. After capturing the match, maximizing tax-advantaged accounts like retirement or health savings vehicles can significantly reduce long-term tax drag. Over decades, the difference between tax-efficient growth and taxable growth can amount to tens of thousands of dollars, not because of better investments, but because of smarter account structure. Compounding without unnecessary tax leakage accelerates outcomes quietly but dramatically. Now let us talk about the first $100,000. This milestone feels distant when starting at zero, but it is transformative. At 8% average returns, $10,000 generates $800 annually. $100,000 generates $8,000. $500,000 generates $40,000. There comes a point where investment growth begins contributing more than your monthly additions. The first $100,000 is difficult because contributions do most of the work. After that, momentum builds. The shift is subtle but powerful. You start seeing months where your portfolio grows more than you personally contributed. That is when compounding begins to feel real rather than theoretical. Consistency matters more than brilliance. Economic history shows repeated cycles of fear and optimism. Recessions occur, recoveries follow, booms expand, corrections reset valuations. Investors who automate contributions through all environments capture long-term growth because they remove emotion from the equation. If markets decline, automated investing buys more shares at lower prices. If markets rise, existing shares appreciate. Either way, time and discipline work in your favor. There is also an overlooked advantage to starting from zero in uncertain times. When valuations are stretched and optimism is extreme, new investors often buy at inflated prices. When uncertainty dominates headlines, prices often reflect caution. Beginning during uncertainty can mean acquiring assets at more reasonable valuations. Historically, disciplined investors who entered markets during fearful periods experienced strong long-term returns. This does not mean timing the market. It means recognizing that fear creates opportunity for those with systems in place. The roadmap from zero to financial independence in 2026 is not glamorous. It does not involve overnight success. It does not rely on predicting macroeconomic shifts perfectly. It relies on controlling what you can control, eliminating high-interest liabilities, building resilience through cash reserves, increasing earning power, investing consistently in diversified, low-cost vehicles. optimizing tax efficiency, maintaining emotional discipline, repeating the process year after year. Many people underestimate how powerful ordinary decisions become when compounded over time. Investing $500 per month at 8% annually for 30 years grows into substantial wealth. Increasing that contribution as income rises accelerates the process dramatically. Avoiding panic during downturns preserves gains. Avoiding speculative excess prevents catastrophic losses. The formula is simple, but execution requires patience. Starting from zero can feel intimidating, but it is also liberating. There are no legacy mistakes anchoring you, no overcomplicated portfolio to untangle, just a clear blueprint and consistent action. Wealth building is less about genius and more about endurance. It is about making rational decisions repeatedly in an emotional world. In 2026, the noise will continue. Headlines will shift from optimism to fear and back again. Technologies will evolve. Policies will change. But the principles of compounding, diversification, discipline, and skill development remain constant. If I woke up tomorrow with nothing invested, I would not ask how to get rich quickly. I would ask how to build a system that works for decades. I would focus on eliminating negative compounding, establishing financial stability, expanding income capacity, deploying capital efficiently, and protecting gains through smart tax positioning. Then I would automate everything possible so that progress continues even when motivation fluctuates. The journey from 0 to 100,000 is the steepest. From 100,000 to $500,000 requires patience. From $500,000 to $1 million often becomes a matter of time and continued discipline. Each stage builds on the previous one. The habits you form in the first year echo through the next 20. In the end, financial independence is not a product of perfect market timing or secret strategies. It is the cumulative result of small, intelligent actions repeated consistently. Starting from zero in 2026 is not a disadvantage. It is an opportunity to implement a clean, optimized system from day one. The noise will tempt you to deviate. The excitement of speculation will try to distract you. But the quiet path of disciplined wealth building has worked across generations. It is not dramatic. It is not viral, but it is reliable. So if you find yourself at zero, remember that zero is simply the beginning of a compounding curve. What matters is the direction you choose next. Eliminate what pulls you backward. Build protection. Increase capacity. Invest broadly. Optimize taxes. Stay consistent. Over time, what once felt impossible becomes inevitable. That is the mathematics of discipline. That is the psychology of wealth. And that is how I would start from zero in 2026.